The largest line item in most of your clients' monthly cash flow is one you never manage. It doesn't appear on your statements, it never gets rebalanced, and it was structured by a lender who has never seen the rest of the plan. This briefing treats the mortgage the way you'd treat any other position, as an allocation with a cost, a holding period, and a liquidity profile. A representative client, $800,000 mortgage at 6.5%, 30-year fixed. The payment is $5,056 a month, $60,600 check, $78 a year. Over the full term, $1,020,000 of interest, more than the loan itself, and the sequence is worse than the total. 86% of the first payment is interest. 6 years in, this client has cleared 8% of the principal. That's a 3-decade commitment of $60,000 a year to a single, illiquid, non-diversified position during peak earning years. The question isn't whether 6.5 is a good rate, it's whether 30 years is the right holding period for that cash flow. The alternative structure. The all-in-one is a first-lien home equity line of credit with sweep checking built in. One account, one lien, the client's entire paycheck deposits into the line. Not an extra payment, the whole deposit, and principal drops the day it lands. Interest accrues daily on the net balance. So every idle dollar offsets loan interest for every day it sits. Bills are paid from the same account, and the balance rises as they spend. There is no formal monthly payment. Accrued interest is debited on the 21st. And structurally, this never converts to an amortizing loan. In practice, a $6,000 paycheck lands on day one, and the balance drops $6,000 that day. In this household, $12,000 a month in, about $4,000 out, the spread applies roughly $8,000 of downward pressure to the balance every month before interest takes its share. No transfers. No discipline required beyond spending less than they earn. The math, assumption stated. Same $800,000 loan, the all-in-one prices at 6.87% so far, plus a 3.25% margin. That is a higher rate than the fixed. Held flat for the entire term with the same household budget. The line retires in 12.4 years. Total interest, $389,000 against $1,020,000 on the fixed. $630,000 of interest never paid at a higher nominal rate on the same budget. The advantage is structural. It comes from the balance falling faster, not from winning on rate. The engine is visible in a single month. Deposits push the balance down, spending draws it partway back, and the gap between where the balance sat and where it would have sat is interest that simply never accrued. Money the client was already going to hold did the work by standing in the right place. Now, the distinction that matters most for planning. Any client can accelerate a fixed mortgage with extra principal, but $1 of extra principal on a fixed loan is illiquid. Recovering it means a refinance or a new equity line. Application, appraisal, closing costs, and qualifying at exactly the moment qualification may be hardest. On the all-in-one, every dollar of paydown stays available on the line. In the model, $137,000 available by year 3, $245,000 by year 5, $369,000 by year 7, drawn without an application, without an appraisal, without closing costs. For your practice, that reservoir is the point. Equity in a fixed mortgage is dead weight on the plan. Real wealth, zero flexibility. Here it becomes deployable capital your client can direct with you, funding the brokerage account, meeting a capital call, seizing a market dislocation, or making the down payment on an investment property. The house stops being outside the plan. Its equity becomes an allocation you can actually advise on. And there's a second release of capital. On this path, the mortgage is gone in 12.4 years, roughly 17.5 years earlier than the fixed schedule. That's 17.5 years of a $5,000 monthly obligation released during peak earning years, over $1 million of contribution capacity that the amortization schedule would otherwise have consumed. Where that capacity gets deployed is a planning conversation, yours. Rate risk, stated fully. The rate is variable and moves with its index the following month. The lifetime cap in this example is 12.87%. The break even. For the fixed loan to come out ahead, the average rate would need to hold above 10.3% for the life of the loan. That break even sits below the cap. A rate that climbs near the ceiling and stays there erases the advantage. That is a real risk, and any presentation that hides it should concern you. Weigh the magnitude. The index tracks the Fed funds rate, which has averaged 1.8% across 25 years. And the asymmetry runs both ways. If rates fall, the client captures it automatically. A fixed rate borrower has to transact and pay to participate. Here's the actual record. 25 years of the index behind this loan. Rising cycles have averaged about 42 months. Falling cycles, about 51. Since 2020, the index has averaged roughly 2.8%. One more disclosure while the chart is up. After year 10, the credit limit steps down monthly. A client on the modeled pace finishes well before that binds. A client behind pace needs to plan for it. The suitability screen is narrow and it happens to describe your book. This works for households with genuine monthly surplus and stable deposit patterns, the same clients who fund their retirement accounts on schedule. It is wrong for thin margin households and for anyone who needs a fixed payment for peace of mind. Clients holding a 3 or 4% rate from 2020 through 2022 are usually better off keeping that loan. Our default answer is to leave it alone, but it isn't automatic. A real cash out need or a plan to redeploy equity can change the math. And that's a case to model, not dismiss. Screening for the right fit is what keeps the referral relationship worth having. 3 implications: positioning. Raising the mortgage extends your advice to the full balance sheet, the largest item on it. Capital flow, recaptured cash, and redrawn equity have to be deployed somewhere. And disciplined households deploy toward the accounts already under management. And the conversation itself is a planning question, not a product pitch. Mortgage free in 12 years instead of 30. What should the difference be doing? The working arrangement is deliberately simple. You spot the fit, the surplus household, the client asking about their equity, the one whose mortgage never comes up in reviews. One introduction. We run the official simulator on their real deposits and spending, and the client gets a personalized comparison with every assumption on the page. Then the decision gets made in a room where their advisor has a seat. The mortgage work is ours. The plan and every dollar this structure frees stays yours. The mortgage is the largest allocation your clients hold. It deserves the same scrutiny as the rest of the plan. Start with one client, the one you thought of 3 minutes ago, at realitysense.com/advisors. The full simulator, the calculators, and the research are there. Bring the plan. We'll bring the balance sheet's biggest line item into it.